Hi, everyone. Thank you for joining us at our second Liam event. And don't forget to join us next Thursday. We have our next one. Today, we welcome Lauren Hicks and Karen Hofmann from Prudential. And I will pass it on to Lauren.
You. Great to be with you all, EMG, during Life Insurance Awareness Month, the great month of September. We're excited about the content that Karen's going to walk you through today, primarily because it's a topic of conversation that seems to be coming up with a lot more frequency, at least in my business in the last 6 to 9 months or so. And I think Karen shaking your head, she's seeing it as well. The business owner market is ripe with opportunity. Both from a business planning, business succession standpoint, but also in the personal planning side. And so it just really makes a lot of sense to spend time here. It is a ever-growing market. It's an ever-growing market among women. And there's a phenomenal opportunity there. So I'm excited for Karen to deliver the content she's got today. In addition to this presentation that we'll be sending out to you, we have a whole host of resources to help you get started in this market, as well as many others. We have a Liam Ceros or website experience that we can share with you that goes through sort of different personas of people that need life insurance, what those needs are, and how to address them. Really great, useful tool, both for virtual engagement with clients, but also just for your own edification. We also have a trimester website that I think many of you actually have leveraged before, but I want to remind you about. That marketing website is sort of an overarching theme for 4 months of the year. And every month we deliver a sales concept that ties back to that theme. Each month, we also do a webinar that educates you on that particular sales concept, and then gives you some real life case studies, case examples from folks in the field like me that are successfully utilizing that sales concept to drive meaningful cases. And so I highly encourage you, sign up for those webinars if you can, utilize the marketing material that's there. Hey, even if you're, kind of sitting there before a meeting and planning out your week and thinking, what am I going to talk about this week? It's a great place to go to sort of get that brain going in the right direction and help you kind of think through what your conversations will be and who you can help. So we'll be sure to send all of those resources out after today's presentation. And with that, I want to introduce you to my esteemed colleague, Karen Hofmann, of Advanced Markets. Traveler extraordinaire. She's probably been 20 presentations this week alone. It's stacked up for the rest of the month. So we're really lucky to be able to have her with us today. And Karen?
Yeah, thanks, Lauren. That ugly couch behind me, I'm actually in a hotel, so I don't have that taste in furniture. Yeah, you can hear from my voice, it has been a very busy month already. September is just crazy. October is going to be just as busy. It seems like, I don't know about you, Lauren, but it's just nuts right now. So we picked this particular presentation. I'm going to just agree with Lauren 100%. I have seen more business continuation cases coming through my team, coming through our regional vice presidents than I've ever in my career. And I think there's a couple of reasons for that. I believe there's a couple of reasons for that. I believe that not thanks to COVID, but because of COVID, there's a lot of businesses that are starting to look and starting to do the planning that they should have done, that they put off. Maybe somebody had lost somebody that either worked for them, a key person or a partner, and realized they hadn't done the right planning and didn't want to make that mistake again. Or just generally, I think we as insurance carriers, insurance companies are trying to get the word out that this is really not only a huge market for you, it's a huge need for your clients. I get a lot of advisors come up to me and say, well, big life cases. I don't have a 20 million, $30 million client. But when you've got business owner clients, not only do you're going to get continual business from them, but you'd also have other, it's like this circle. You get key man, executive bonus, deferred comp, buy, sell, and you're continually updating these things and continually, going back and revisiting these cases. And when you get in when you get a referral from one business, you'll get a referral from a friend of that business, and it just really does grow. So what I'm going to try to do is a couple of things. I'm going to try to have you understand the need, and then I'm going to try to have you explain why they would want to do business continuation, because I think what's holding a lot of advisors up is they don't know what questions to ask, and they don't know how to sort of open the conversation. And quite frankly, I find a lot of times they do it at the wrong time. So if you look at the market, if you look at the slide, we're looking at owners. Owners of very closely held, or very small, closely held businesses, right? We're not looking at huge companies. We're not looking at public traded companies. We're looking at small, closely held businesses that have, let's say 500 or fewer employees. Probably we're looking at a lot less than that, right? Most small businesses don't have 500 employees, but they usually have, anywhere from a few to a couple hundred. But what's really the key to this is they need to care about what happens to the business if something would happen to them. Now, that seems like a dumb question to me, because if you've started a business and you've put a lot of work and blood, sweat, and tears into this business, why would you not care about what happens to the business? There's nobody in their right mind that would not care about that. And so, I'm going to give you some questions to ask, but they do care, but they just don't have the time, or they have not thought about the planning that goes into it. And the last thing that's really, really important, and we'll get into this a little bit more, is they really want to make sure that if something were to happen to them, that they get a fair payment for their share of the business. Well, it's not necessarily they would get the fair payment for the share of the business. Their spouse or their heirs would get a fair payment for the share of their business, because the last thing a business owner wants is for something to happen to him or her, they pass away, and their kids or their spouse gets nothing. That really is never something that they would ever consider, but it happens. It happens all the time. I have heard so many nightmare stories. I've seen it happen firsthand, where a spouse is waiting. Where's my money, right? Where's my money? And they're not getting it because there is none. So the opportunity, as Lauren said, is really, really big. There are 32.5 million small businesses in the US. Small business is the heart of this country. And the strangest thing is, between 2020 and 2021, the number of small businesses, let me say that one minute, who plan to retire doubled. Now, again, that could be for a couple of reasons. It could be because things didn't go so well during COVID and they decided to just hang it up. Or they just realized maybe life is, this is the time. But it's important that we make sure not only that they're protected if something were to happen to them unexpectedly, but we also have to help them prepare for retirement as well. So this is sort of part of the conversation, and it will lead to the conversation about retirement as well. But the biggest thing is, and I know this for a fact, 60 to 70% of small businesses want to pass their business to the next generation. If you're working with small businesses that are family owned, it means so much to them to pass that business onto a family member. It just really does. Now, sometimes there isn't a family member that wants to take over the business. Again, we have to manage for that. We have to plan for that. But a lot of times they do have one or more children that are in the business, and maybe some children that aren't in the business. Again, we can help them with that. We can make sure that business goes to the next generation. with the right planning, with your help and the right planning. And so, just sort of moving on, stats, there are lots of stats out there. Let's just sort of get into why. Why would you have these conversations? Why is it so important, right? So I want to teach you to understand the advantages. If you're passionate about this, like I am, you'll be able to be passionate to your business owner clients to actually point out the economic advantages of buy-sell arrangements for their businesses, and obviously understand why we do use life insurance, and we're going to talk about that. It's very important that they understand why we use life insurance in these types of planning strategies. So I'm going to go through 4 steps: understanding the need, how to select the right plan type, which often comes up a lot. I get a lot of questions from FAs like yourself on this. And then placing a value on the business is always sometimes an issue, but we're going to solve that problem for you today. All right. So what is the worst possible case scenario? Businesses are forced to liquidate upon the death of a business owner. Fair market value may be significantly reduced, goodwill is lost, and family control is lost. Let me give you an example. Business owner passes away. He has a partner. Or let's say, for example, let's just say his partner, let me reverse this. His partner passes away, okay? There's 2 of them. They run a very successful business. The partner passes away. Without any planning whatsoever, he is now going to be in business with his partner's family, okay? Now the spouse or the heirs of his partner are now his partner. Now there's probably a good chance that they want out. They don't want to be in the business. They have nothing to do with the business. It's the last thing that they want, and they want to move on. They don't want to be in the business. They don't want to be in partnership. So what will happen is, if the remaining business partner can't afford to buy out, let's say that spouse, the spouse could potentially sell her or his share of the business to somebody else, or try to sell the business, or try to force the business to liquidate so they can get paid. So there's a lot of, really bad scenarios that can happen here if it isn't planned for. So many businesses end up being forced to liquidate because there's not enough cash to buy out family members. They usually liquidate at a significant discount to a competitor, right? Which means goodwill is lost, family control is lost, and that fair market of the value of the business is pretty much shot at that point, right? And, I'm often asked, well, what kind of questions can I get to start this conversation? And if you look at the slide, I would not ask these questions. I would not ask these questions. This is a compliance slide that says this is the way you should ask a question. Somebody else wrote these questions. I would never ask, are you interested? I would be saying, what have you done to make sure the continuation of your business after your death? Are there family members that you want to continue the business? What have you done in case something has happened to you to make sure that your spouse is financially secure, right? What have you done to make sure that your business wouldn't get sold at a discount or a fire sale in the event that something would happen to you and your spouse wouldn't get the fair price for your share of the business? What have you done? The other questions I would be saying is, what have you done? Or do you have a will? Have you have a written will for your business? And a lot of times they'll look at you and ask, well, a written will, what does that mean for my business? Well, your business will be part of your will, but it's going to go via, the will, right? Is that how you want it to go? Do you want it to go to the partner's family, or do you want it to go to your family, right? Do you want to be in business with your partner's spouse or family members? That is a question that always gets them staring at you in shock. Put it that way. What have you done to make sure you're not in business with your partner's family? Okay. Because if you don't do the right planning, that could happen. And that may not be what you want to happen. So a buy-sell agreement is a written agreement. It is a written binding agreement. It creates a media market for the business interest. It says who will buy out the business, the other partners, okay, usually. It would say who it is and when. It's immediate. It protects against that spouse or kid selling the business or their shares to somebody else that you don't want. Protects against unwanted owners. What it does is, done right, it provides the immediate funds to buy out the spouse and the heirs immediately. They don't have to wait for their money. They don't have to sit around drawing off or depleting profits or trying to sell their share of the business to somebody else. It provides the money immediately. It also provides a valuation of the business, which is very important. I'll talk about that a little bit later because we can help you with that. And it also helps reduce risks of disputes with the IRS. It's in writing. The valuation is in there. There's no question on the value of the business. And the value of the business tends to be a roadblock. I find a lot of times, I was talking to some people this week at a conference, and they said the hardest thing when they're talking to business owners is coming up with a number, okay? Coming up with a number, because a lot of times business owners don't know what the number is. They undervalue it, they overvalue it. They don't want to spend the money to do a business valuation. And so just to let everybody on this call know, if you need help with business valuation, one of the team members on my team is able to do that for you. It's a really nice business valuation. It's an informal, but it's pretty accurate. And we will provide you with that if you provide us 3 years of tax returns. Now, obviously, we want to do it to help you get the business, right? So we would like to make sure that it's valid for valid purposes and that we are looking at a buy-sell arrangement, and we would definitely help you with that. We just don't want to be just doing valuations here, there, and everywhere, because that's not a good use of our time. But definitely, if you have a case that you're working on and you need help, let us know. Please reach out to EMG, who will reach out to Lauren, who will reach out to my team. So what is the right type of buy-sell agreements? There's usually two. Most of the time, there's a few more. I'm just going to talk about two: the cross-purchase and the entity purchase, or sometimes called the stock redemption. And basically, it's very simple to explain. This is really not rocket science. This is easy. We have two owners. They own a business together. And basically, they have an agreement between each other. They agree to buy life insurance policies on each other. They pay the premiums on each one's life insurance policy, and each one is the other one's beneficiary. That's it. Let's say owner B dies. Owner A receives the tax-free death benefit immediately. Owner A then goes to owner B's family, buys the ownership interest from the family immediately in cash, and now becomes 100% owner of the business. Boom, done. All planned for, all easy to accomplish. The advantages is the remaining owner now gets full step up in basis of whatever the stock or the shares or the partnership interest was. The life insurance are owned by themselves. And then, it's a better way of doing it if you don't want to do a stock redemption arrangement. We'll talk about that in a second. The only disadvantages is the shareholder. This is what I find. The only disadvantages is the shareholders pay the premiums themselves, which means if you've got a lot of shareholders, you got a lot of policies, which isn't the worst thing in the world, right? Writing a lot of life insurance policies isn't the worst thing, but the thing that does come up the most is where we've got older owners versus younger owners. So because they're buying policies on each other, the younger owners are actually paying more in premiums because the older owners are older and they may have other health issues. This can be overcome. Okay, this is not the end of the world. We can make them whole by maybe bonusing out some extra cash to the others, the younger owners, to make up for the fact that they're paying a bigger premium, right? So it's not the end of the world. And there's other ways of doing it. We could do what they call a trust deed cross purchase, where we just have the policies owned by a trust. Again, that's a little easier, but then you've got trusts involved and that kind of thing. So let us know if you run into a situation that you're not sure or you want some help on this. We have a very large, Pru has a very large advanced markets team, very large, and there's a lot of us, very knowledgeable. We can provide you with copies of buy-sell agreements, samples. We've got a whole slew, as Lauren said, of marketing materials. And there's a small business ebook going through all of these things with downloadable copies of purchase agreements and all sorts of stuff. So please let us know. So on the entity is a little different, or again, stock redemption, sometimes it's called. It just means that the agreement is between the owners and the business. The business owns the policies, the business pays the premiums, the business is the beneficiary. So really it just works the same way. Somebody dies, instead of the other owner purchasing the stock or the shares, the business redeems the stock and the shares. And now the remaining owner now owns 100% of the stock that the business owns, right? So similar, but different. There's reasons to do one versus the other. Here's one of the reasons that you might consider doing one or the other. I'm not sure. I'm not going to read this. Definitely not going to read this. You can read this yourself. But if you have a business-owned life insurance policy where the business is the owner and the beneficiary, you have to follow Section 101J. Section 101J says that if there's a policy owned, the insured must sign a consent form saying that they agree that the business owns the policy and the business is the beneficiary, right? So there's a one-page consent form, very easy. We've got samples of them that we don't provide them, but certainly get you samples of them. And it just says, hey, I agree that, I'm being insured and the business owns the policy, right? And for most owners, executives, and key employees, this isn't necessary. It's actually exempt, because really what it was designed to do was make sure businesses weren't putting policies on the lives of their rank and file employees, right? But one of the other things is, if you see on the bottom of this screen here, it imposes annual reporting and record keeping requirements. So basically it says that each and every year, if you have employer-owned life insurance on employees, regardless of who they are, there's a form 8925, IRS form 8925, that has to be filed each and every year with the IRS, so they know that there's policies. Now, I just said that directors and highly compensated individuals and executives are exempt, but there's no exemption to this annual filing. Now, if they do not comply with 101J, what's going to happen if they don't do what they're supposed to do? If they don't do what they're supposed to do, it makes or creates or turns the death benefit into a taxable death benefit versus a tax-free death benefit. So one of the things I really like to tell people is, when they're working with business owners, please make sure you follow the rules of 101J. We have some great pieces on it to make so you can understand how it works. If you run into businesses that have business-owned life insurance, you might want to ask them, or at least contact their CPA to make sure that that annual reporting is being done. Now, people ask me, well, what if it isn't being done, Karen, and what could happen? Well, it could turn a tax-free death benefit into a taxable death benefit. Well, how is the IRS going to know? Well, probably in an audit, if there ever was one. They might have been getting away with it for years. Now, how do they correct it? They can correct it. It is possible to correct it. They'd have to do a 1035 exchange into a new policy, with at least one change in the new policy being $1 more of premium or $1 more of death benefit. So it can be identical, but doing a 1035 into a new policy and then going on from there would correct the problem. Otherwise, if they don't do anything, they're taking a chance that this could be a taxable death benefit. And I don't know about you, but if I found that out later, I'd be not so happy at somebody. Okay. So anyway, check with CPAs. They're the ones that do the annual reporting, and they're the ones that would know if they're doing it right. Okay, so the entity is only one policy per shareholder. The good thing, and what we often find, is businesses want to use the business checkbook to pay the premiums. So the business pays the premiums, right? Still easy to implement, still easy to understand. The only disadvantages are the policies are owned by the business, so they are subject to corporate creditors. There's some issues with what we call family attribution. Don't want to spend too much time on it, but be careful with C corporations and family members. The redemption of C Corp stock could create an adverse taxable event. Changes from a capital gains event to an ordinary income event. So family members and C corporations, when we're redeeming the stock, could have an issue. Again, check with us. We'll let you know how it works. And the other thing is there's no increase in basis in C Corp. So S Corp's basis is fluid, goes up and down every year, but C Corp's basis stays the same. So the original basis in the original C Corp will not get a step up. So if they later sell their C Corp stock, some of that is going to retain its original basis. Okay, so it's not quite the same as it is with pass-through entities. So the business valuation, I mentioned that before, excuse me, it is very important to have it. It can be an issue when you're talking, because a lot of times the business doesn't know what it's valued at. Again, they've got two choices: go out and get a business valuation done by a business valuation company, or again, come to Pru and we will definitely help you with that. Doesn't take us very long. And again, it's pretty accurate. All right, so lastly, let's just talk about funding. So the business owner may ask you, well, why do we use life insurance, or why is this all about life insurance? Right. So let's just think about it. Let's step back. You have a spouse who's now your partner, right? Your partner's passed away. You're now in business with your spouse. You have an agreement in place that you are to buy out the stock from the decedent's family, right? You've got the agreement, but what's going to fund this agreement? Without life insurance, let's just say we don't want to do life insurance, or for whatever reason. So here are your options. I can go to the bank, borrow the money to pay off the spouse, right? I don't want him or her my partner, and they don't want to be a partner. So I'm going to go to the bank. I'm going to borrow the money. Okay, I might be able to borrow it. I might not. It's going to really put a strain on me. So it may be difficult for me to get this loan. But at the end of the day, if I'm borrowing $1, it's going to cost me $1 plus interest to pay it back. So it's very costly to borrow money to buy out a spouse or a family member, right? It's really, really a bad time. Just lost a partner, and now I'm going to the bank. Usually doesn't work. The other way I could do it is I could have some kind of sinking fund where I put money aside, or we put money aside, the business puts money aside each and every year, just in case this happens, right? But now I don't know when it's going to happen. I may not have enough in that sinking fund. I can't have too much money sitting in a corporation, a C Corp especially, without running in afoul of what they call the accumulated earnings tax. I have to have it for a reason. And you might run into that issue. And again, I don't want to spend too much time there, but it could be an accumulated earnings tax. Maybe not. But the thing is, it's not guaranteed at the time of the buyout. I don't know when this event is going to happen. I may not have anything in the sinking fund, or I may not have enough, right? The third option, which is normally what happens, and this is what I see a lot in businesses, we enter into an installment arrangement. So now I've got my partner's spouse. Okay, let's say she and I have an agreement. I'm going to buy her out, but I'm going to buy her out over a period of time using an installment agreement. Every year, I'm going to buy partially the business interest of my decedent partner from her, from corporate profits, right? Now, that may be perfect. She's going to have to wait until I can do this over time, but this is the only way I can afford to do this without putting a financial strain on my business. But here's what I've heard. I've heard that this is a nightmare, because some years she may get a payment and some years she may not. She's still expecting half the profits from the business. She's still waiting for her money. She doesn't want to be a shareholder for the next 10 years or however long it takes for me to buy her out, right? It depends on future profits. It puts a real big strain on the business, and it's a pain. It's a pain to do this. So 99% of the time, we use life insurance. Sorry, I'm trying to move my slide and it's not moving. Why would I use life insurance? Because if I'm covering $1,000, let's say $1,000 for a 500,000 policy, right? I've got a buy sell with a $500,000 policy. Each $1,000 of that 500,000 isn't costing me 500,000. It's costing me cents or dollars, right? So borrowing 500,000 is going to cost me 500,000. An installment agreement with 500,000 is going to cost me 500,000. A $500,000 life insurance policy is going to cost me, if I'm 35, $6 and it says 20 cents on this slide, $6.20 for every $1,000. Or if I'm 45, $9.73. So it's a very discounted way of providing for funding an agreement with the least, I'm trying to find the right words, the least amount of money. And it's available immediately, day one. Okay, no waiting, no borrowing. Okay, easy, done. Everything is done. The business, the remaining business owner now moves on. So I'm just going to look quickly at my, it's about 8. Sorry, I'm 8. I'm on Pacific Coast. It's 10:30. Lauren, Vanessa, I'm sort of going to close up here. I don't know if you want to make any other comments on what I just kind of covered. I don't know if something stuck out at you on what I said. Just remember there's a lot of needs with business owners. There's a key person. We could spend another hour talking about that. We could spend another hour talking about executive benefit plans, right? And then their personal needs. Anybody have any other comments? Because I went fairly quickly. I'm not going to take up the whole hour.
Vanessa, do we have the ability to do Q&A on this through the chat function?
Yes, if anybody has questions, please type them in and I will go ahead and we'll be able to see them. So we'll give.
While we're waiting for Q&A, don't forget about existing businesses that have existing policies on the books, right, Lauren? A lot of times, I heard somebody talk about it yesterday at another conference this week. She said, businesses grow. And just because they put a buy-sell arrangement in 5 years ago, $1 million, the business could be worth $10 million. Well, they've got a buy-sell arrangement that's funding a $1 million policy. We've got a $9 million shortfall, right? So don't forget, they have ongoing needs as the business grows and grows and grows. You'll be constantly going back and reviewing those policies and increasing the policies as the business gets bigger. And also look at businesses. You can look at startups. Startups tend to be a little cash poor, right, in the beginning. And if you're looking at a startup or it really doesn't have the money, start them out with a term with a conversion option, right? Just start them out with the cheapest. That if they really have a hard time with cash flow, they really feel the need is there, but the cash flow isn't, stick a term on there with a good conversion option.
I was gonna also add on to your comments, Karen, was don't forget about those term policies that business owners have in place that you can convert. I mean, one of the more meaningful overfunded permanent cases I worked on in the last 6 months was they had a term policy with Pru. And now the cash flow was significantly better. They had a need for retirement income planning. And so we converted that into a really nice overfunded VUL, and it checked all the boxes. And was easy because it was a conversion. The owner loved it because he wasn't having to go through underwriting. I mean, there were so many wins about that situation that opened up the door for additional conversations, from there on out. I see we do have one question from
Mhm.
Clay Lund out of Houston, Texas. Hi, Clay. Can you give me an overview when LLCs could be used as the vehicle to do buy-sell planning? Seems this is a growing trend.
Yeah, I've seen this before with, I mentioned with the cross purchase where if there's a lot of policies, right, it becomes a little overwhelming. And that you're right, Clay, there is a trend where they actually establish an LLC instead and have the policies owned by the LLC. It's one way of getting around the need for multiple policies. It's similar to having a trust, but instead of going through the whole trust thing, they actually just form an LLC. And then that way there's only one policy per owner versus 100 policies if you've got a lot of owners. I think we might have a piece on using LLCs for buy sells. It doesn't come up a lot. I would just say it does. It is something you might want to look at if you have a business with lots of owners. And disproportionate percentage of ownership and that kind of thing. Using an LLC kind of wraps it, if that makes any sense.
You have a piece, Karen. Clay, I'll make sure to,
Yeah. But thank you, Clay, for asking that question.
I don't see any more questions, so I think we can go ahead and close out. So thank you, everyone, for joining us, and thank you, Karen and Lauren, for being here and presenting. That was an amazing presentation. Just a reminder for everyone, next week's event is estate planning with life insurance and a rising interest rate environment. So head to our website to register. And if you have any further questions, you can contact us and, we'll send those questions out to Lauren and Karen. And we look forward to see everyone soon. Thank you.
Another question in the chat. Oh, thank you.
Thank you.
Thanks.
Yeah.